on this morning's Ag Issues program. As always, a pleasure to bring on to the program. You hear him every couple of weeks, Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Just fine, thanks.
Well, I appreciate you, as always, coming on to the program. And, you know, last year, this was up for discussion last year. People remember the derecho, the inland hurricane that stretched from Nebraska to almost the Ohio-Indiana line, and we know how much damage that caused. But, of course, here in the Great Plains, Kansas included, that, of course, had the hurricane-force winds. I think officially they termed it a derecho as well, with those types of winds and tornadoes in Nebraska, Kansas, Iowa, and Minnesota. But what was discussed, of course, is the damage that took place involving farm buildings and structures, and as you have deemed it, the 2021 version, as some of these farmers and ranchers assess their damage, the question comes up, is there any type of tax benefit, well, potentially to demolishing those buildings, farm buildings and structures that were damaged?
Yeah, and I'll tell you what, first of all, Greg, when the storm hit in August of 20, so about 16 months ago, I had never heard that term derecho before. I don't know if you had or not. I know you work with the weather people, and you've done so for years. Had you ever heard that term before?
One time, and it was a long time ago.
Okay. I heard that, and I thought, what are they talking about? I had never heard that term before, so I just assumed it was a term that they came up with to explain a hurricane that hits a part of the country that New York and Los Angeles don't care about. But anyway, it did create, that one in August of 20 created a lot of damage in about a 50 to 70 mile wide band from Nebraska, just about to the Ohio-Indiana line. This one was broader in its coverage, and it had numerous tornadoes, and it kind of wandered all over the place, and it hit Kansas pretty hard, moved up into Iowa, into Minnesota. In fact, I think it generated the first ever December tornado in Minnesota, if I recall the news report right. But then the questions come for a farmer or rancher that has buildings that have been damaged or structures that have been damaged, farm buildings, farm structures that have been damaged by this. What are the tax rules going to be associated with cleaning up that mess or rebuilding that structure? And in anticipation of those questions, the last time this thing occurred last year, I produced an article, blog article on this, and I updated and redid that article in light of this most recent event. And then I'd like to throw in one other thing, and I didn't put this in the list to you, Greg, but let's talk, when we get through this, let's talk about what happens if you lost livestock in this, because we also had a fire in Kansas that wiped out a bunch of livestock out in the Plainville area north of Hayes. And so let's throw that in too. But first, when we talk about buildings and structures, basically we start with the proposition that we have a code section that says that anytime you demolish a structure, you're not going to get a deduction for the amount that you expend in demolishing that structure, and you're not going to get any loss deduction on account of the demolition. So what do you do with that cost? Well, you add it into the basis of your land. Now, that's the general rule. There's another general rule that's out there that says, well, if you were using that building or structure in your farming, trade, or business for a period of time before it got demolished, then depreciation can be claimed for the period of business use. Now, this storm occurred so late in the year that you're going to get almost a full year's worth of depreciation on that building or that structure if you'd used it in your farming business for the entire year. But any undepreciated basis of that building or structure would be, again, added to the basis of the underlying land along with those demolition costs. So that's where we start with the proposition. If you just abandon these things, I'd say, well, those are pretty well destroyed. I don't think I'm going to use them anymore anyway. I'm just going to abandon those buildings. I'm not going to tear them down. I'm just going to leave them sit there. Any remaining basis is treated as a disposition or sale at a zero price. So what that means is that the remaining income tax basis becomes an ordinary loss that you report on your return on a Form 4797. If you eventually then demolish those buildings that have been abandoned at least a year after you stopped using them, in your farm business, then they now have a remaining basis, and only the cost of demolition would be added to the land's basis. So those are your three basic general rules that we start with.
And this is one, because I was just going to ask that there's certain time frames in this aspect of, like you said, well, you just abandon it after you don't use it for X amount of time. So time frames in this sound like they're very important on whatever that farmer or rancher decides.
Yeah, that 1 year time frame is pretty critical. So if you're sitting there and wondering about what you're going to do with these buildings and structures that have been destroyed or damaged, and you wait a year on this, that means it's an abandonment, and then your tax rules change, as I indicated. So your basis becomes an ordinary loss. Any remaining basis in those structures is an ordinary loss that you're going to report on the 4797. So you would report that for the year of the loss. So what we're talking about in these situations would be the filing of amended returns in many situations.
And then as well, just understanding the tax rules surrounding the disposition and the disaffected assets as well. Make sure you understand those too.
Yeah, and the big exception to those rules I just laid out is going to come into play for a lot of these Kansas farmers and ranchers, and that is the rule that when you have a demolition after a casualty, and that's what we just had. So when a casualty event occurs, such as this, these high winds that went through, your normal capitalization rule does not apply when the structure that is damaged by the casualty has been demolished. So what that means is we get a more favorable rule if the demolition occurs because of a casualty. And so the general rules that I scoped out when we started talking would be, if I buy a farm and there's structures on it, I want to demolish those and build new structures. So your rule is you add that to the basis of the land. Now, if the demolition occurs because I had a casualty to those structures, the IRS says the capitalization rule does not apply to amounts that you expend to demolish a structure that's damaged or destroyed by a casualty, and to any loss sustained on account of that. That's a better rule. So instead, what happens in this situation is that the income tax basis of the structure is reduced by any deductible casualty loss before the loss sustained on account of the demolition is determined. So that means for a farm building or structure that was destroyed by this recent hurricane, inland hurricane or derecho or whatever they call it, then the basis in the building or the structure at the time of the casualty is deducted as a casualty loss, but the cost of cleaning up the mess left behind gets capitalized in the land's basis. We can't do anything about that. So we get a more favorable rule in this type of situation. So you do get some type of deduction for demolishing a farm building or structure that has been damaged by a casualty event like this weather event that occurred.
So you mentioned as well the wildfire situation, and unfortunately we got many Kansas ranchers who have had to go through that back in 2015 and 2016, but nonetheless still a situation on all those who lost livestock, and there were many who did as well, as to what their next steps are going to be.
Yeah, and that's where the livestock indemnity program can come into play. That's a USDA program. The payments are set at 75% of the market value of the livestock as of the day before their death. And there are a lot of technical rules that have to be satisfied in terms of ownership of the livestock and the producer being able to prove what livestock they had, how long they owned them, those types of things. The tax reporting of those payments, let's say you get, and these LIP payments are not limited by the payment limitation, the general payment limitation of $125,000. That was removed a few years ago. So if you had massive livestock losses, your LIP payments are not going to count against or be limited by the overall payment limitation. But from a tax standpoint, you're going to get a 1099-G from USDA reports. It's a government payment, so it's going to be a 1099-G. IRS is going to see that. And sometimes these payments are not paid until the calendar year after year in which the loss was sustained, and that's likely to happen this year because this occurred so late in the year. And so the one thing I would point out in the interest of time here, just to shorten things down here, is if you had death of breeding livestock, you got to be real careful with that 1099-G. That 1099-G is only going to report the gross amount of any lip payment to a producer for the year. But there may be situations where a portion of that payment is compensation for the death loss of breeding livestock. So if that producer would have sold the breeding livestock, then the sale would have triggered what we call 1231 gain. That would have been reported on Form 4797, not a Schedule F. So that raises the question as to whether it's possible to allocate the portion of the disaster proceeds allocable to breeding livestock that were lost in the fire from Schedule F to Form 4797. That's a big deal because Schedule F picks up and applies self-employment tax. Form 4797 does not. That's a 15.3% tax difference right there. So your gains and losses from the sale of breeding livestock go on the 4797, but the IRS is going to look at that Form 1099-G amount paid for livestock. They're going to want to see all of that show up on the Schedule F, most likely on what would be line 4A. I would say producers in that situation, if you've got good records as to breeding livestock that was lost compared to other livestock, then have your tax practitioner attach a statement to your return, do the allocation yourself, make sure it totals up to the total amount on the 1099-G, but then break it out so that you're not getting unnecessarily hit with self-employment tax.
Roger McEowen, professor of agricultural law and taxation at the Washburn University School of Law, is our guest on the program this morning. And Roger, we move from weather-related issue to gifting. Of course, this is the time of giving and, Christmas gifts to children. It might take the form of an ag commodity, or in this case, gifting ag commodities to children. But there are some questions and ways that this should be structured and what the tax consequences are as well.
Yeah, we're really talking about overall family tax planning when it comes to gifting ag commodities to children and how it should be structured and what the tax consequences are and what the status of the current law is with respect to commodity gifts to children. It's really, in the right situations, it can really be a good tax planning technique overall for the parents as well as the children because the donor, the parents as the donor or donors, they don't recognize income upon gift of unsold grain inventory. So instead of selling that grain, they're gifting it, so they're not triggering any gain on sale. That gift of the unsold raised farm commodities represents a transfer of an asset, inventory, rather than an assignment of income. So that was something that was litigated many, many years ago. IRS would say, well, you're just assigning your income. You would have sold that grain. You've assigned it to the kids, so it's still taxable to you. And the courts disagreed with that. So that means that a farmer, as the donor, is going to sidestep the income tax on commodities that are transferred by gift to another taxpayer. And since you're not triggering a sale, there's no income on sale, then you're avoiding self-employment tax also on those commodities because the excludable gross income is not considered in determining self-employment income. So I think that's particularly beneficial to donor parents that have income under the Social Security wage-based threshold where they would experience the entire hit. And that's $142,800 for this year. That's going to go to $147,000 next year. So those people in that income range would get the full benefit of avoiding self-employment tax on gifted grain. Now, one key point on gifting commodities is that those commodities that are gifted should have been raised or produced in a prior tax year. That's a key point. Because if that's not the case, then the IRS is going to take the position that a farmer is not 100% in the business of raising ag commodities for profit, and then they're going to require a pro rata share of the expenses of raising the gifted commodity to then fall in a category where it's not going to be deductible on the return. So as we come down late in the year, make the gift in 2022 of the 21 crop to get around that potential problem with the IRS, because the IRS will say, well, if you gifted part of your 2021 crop to a child, then your opening inventory has to be reduced for any cost or undeducted expenses relating to that transferred property. So that means you're not going to be able to deduct your current year costs applicable to the amount of the commodity that you gifted. You want to avoid that. We can deduct the costs on prior returns. That's no problem. So just wait until next week. Make the gift of the 21 crop. You get around all that rule. And again, this applies if you are calendar year basis, cash method farmer. And so I'm making that assumption in this discussion that that's what most farmers are. Now, I understand some are not, and there's a good reason not to be for those. But if you are calendar year basis, cash method, you get full deductibility of your expenses if the gift of raised commodity is not made until the tax year after harvest.
So you talked about, in this case, the consequences or what needs to be done if you're the donor. So are there tax consequences to the donee?
Well, there are, and they're not bad in this situation. The parent's basis in the commodity carries over to the kids. So in the case of raised commodities, given in the year after harvest by a cash method producer, then the child's going to receive the donor's basis, which is zero. You don't have an income tax basis in raised commodities. So that's what we would expect. That's not really problematic. It's just the children have to realize they have a zero basis in that. So when they sell it, it would all be taxable as gain. Now, if the farmer is on the accrual method of accounting, then they'll have an income tax basis in those raised commodities. And as that basis approaches the market value of the commodity, there'll be little income shifting accomplished from a gift. Just something else that people need to talk to their tax practitioners about. Now, the vast majority of farmers are not on the accrual method of accounting, so that rule may not come into apply in most situations. And assuming that the children did not materially participate in the production of the commodity, so they're not in the farming operation, they're not involved in the production activity, then the income from the sale of the commodity by them when they sell it is treated as unearned income, therefore not subject to self-employment tax. So there's a chance here, if this works out right, in a particular family situation, parents avoid the income from sale of the grain, they avoid self-employment tax, and the children sell it, it's taxed at the children's tax rates and potentially not subject to self-employment tax at that level either.
All right, so let's look at this. We talked about it from a grain perspective. What about gifts of livestock?
Well, if you receive, let's say the children received raised animals and they take responsibility for the care and the feeding of those animals after the date of the gift, then IRS could say, well, you are now materially participating in the raising of the animals. Therefore, when you sell them, you're subject to self-employment tax. So I think the advice here is to avoid IRS making that argument. If you physically segregate the livestock at the time the gift is made, that's going to be helpful. And any post-gift maintenance expenses for those animals should be paid by the children. And that'll help keep things separate, and I think you can avoid a successful argument by IRS that the children would owe self-employment tax on the eventual sale of those animals.
Bottom line in all this, how you structure your transaction is key for this to work out as properly as it should.
Yeah, that's right. Structuring it as proper is very important, and it has to be properly done. And that means that this is not one of those things you want to do yourself. You want to have a competent ag tax practitioner helping you through all of this. But it can provide, I've seen situations where, you have $25,000 of taxes that can be saved in the right situation. So it's worth it to some families to take a look at this. It may fit in your overall tax plan here near year end, particularly with the gifting of the grain, maybe starting next week of this year's crop. And then make sure you have competent professional counsel help you through it. And maybe you can get a good tax benefit here at the end of the year.
All right, Roger, sounds good. As always, very much appreciate you coming on to the program. And, of course, looking forward to our usual look back at the year on some of the cases. We always have a lot of fun with that. So I'm looking forward to that and appreciate it.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us this morning on the Ag Issues program here on 580 WIBW.